Thank you, and a very warm welcome, our dear guests, our panelists. We're going to talk about energy transition and acceleration of energy transition and investments in Europe. And if you're asked to moderate a panel about energy transition, I don't think your panelist gets any better than this. So, I'm very, very excited. Thank you for joining us. Thank you for being with us. My name is Alper Kılıç. I run the project and export finance business at Standard Chartered Bank globally. So let me introduce our wonderful panelists to you today. We have Aurélien Hamel, President of Strategy and Sustainability at TotalEnergies, also member of the Executive Committee. We have Philippe Lacan, Head of Investments, Acquisitions and Advisory at Engie. We have Andreas Christoffersen, Senior Corporate Finance Specialist at Vestas, and Henrik Reber, Global Head of Global Credit Markets at Standard Chartered Bank. Once again, welcome. Now, energy transition, the world, we have been all using a lot these days as professionals and bankers. And probably the official date that the world has been introduced to our lives would have been, I would say, here in Paris in 2015 during the Paris climate discussions. It was in a suburb 30 minutes from here. And since then, energy transition and net zero have been part of our lives. As Christophe kindly said in his opening speech, I think there's a very wide acceptance by the corporates, by the governments, institutions, and also individuals that the climate change will have to accelerate. And the target that has been set out in 2015 in Paris during those climate discussions was that the temperature rise to be limited to 1.5 degrees compared to the pre-industrial levels by 2030. During the same discussions, there was a target to achieve net zero by 2050. Right? Now, we are in 2024. I am ever an optimist. I'm not a pessimist. Yes, there are challenges. We'll talk about that a little bit, maybe. But I think overall, we will talk about what that transition actually means, what has happened since, and we have 6 years to go to 2030 and 24 to 2050. So what do we need to do if we want to achieve those targets, and what are the challenges? Now, there are two components needed. I think one is the belief and commitment to achieve these targets, but at the same time, the access and availability of cost and access to the financing to make the transition happen. I think the commitment part has happened. We will touch on the cost part of it and technology part of it and other broader terms around that. So for the purpose of this discussion, I would like to use the definition of energy transition as agreed or as stated during the COP28 in Dubai, which says the transitioning away from fossil fuels in energy systems in a just, orderly, and equitable manner, underpinned by deep cuts and reliable finance. Now, as a banker, I will associate it with that a lot, in a just, equitable manner. But you're not here to listen to me, and I'm going to start, turning to my panelists right away. On my right, Aurélien, TotalEnergies, of course, historically, and even now, maybe significant majority of the business is with oil and gas. But also TotalEnergies have been at the forefront of this energy transition, this change. What is the strategy? Can you explain to us, what has worked vis-a-vis the strategy targeted by TotalEnergies and what is to be done, please?
Okay. Thank you, Alper, and thank you for having me here today. So on this part of the discussion, usually I throw a lot of figures, so I'll try to refrain from that, and if I do, please throw something away at me. Those are the front row here. So to start with, what we do is we look at the energy markets today, because transition away from fossil fuels, which we adhere to, you need to know where you're coming from and obviously where you're going to. And what we do is, if we want to take a very, very high helicopter view, it's even a space station view here. When you look at the energy, what's very interesting is to look at the energy segments and how much they emit, because energy transition is here because we need to emit less CO2, less methane, basically. Otherwise, there will be no discussion on the transition, because availability of commodities is not a question medium term, actually. So now looking at that, today the world emits around 55 gigatons of GHG, CO2 equivalent per year. And in that, the biggest emitter is power generation. Power generation has 13 gigatons of emissions of CO2 equivalent per year, 75% of that coming from coal. Okay? So target number one in the transition, power generation, less coal, more low carbon, no carbon power generation solutions, and I'll talk about that in a moment, obviously. Then target number two will be transportation, almost entirely based on oil today, be it road, maritime, air transportation, even space transportation to some extent. It's a minor part, actually. And in this respect, it's around 9 gigatons per year, okay? Target number three will be the industry, 6 gigatons per year, half coal, and the rest is oil and gas. And then I will add another one, which is privy to my industry, which is methane. Methane is emitted by the agricultural activities, but also by energy production. And energy production accounts for 4 gigatons of methane emissions per year. That's a lot. And that's very much important short term, actually, because methane heats up the atmosphere way more than CO2. We're talking 80 times more in the course of 20 years. When you compare the two gases, basically. So once you look at that, you can frame a transition away strategy, basically. And so how do we do that? We look at these segments and we say, okay, there's oil and gas, there's power generation. How do we contribute to decarbonizing power generation? It's a new business as far as we're concerned, newish. We've been there now for close to 10 years. We've been selling electricity a long time, but producing is new. Then there's transportation. So how do we fit into that? What we do is, first, there is going to be an oil and gas demand, medium, long term, actually. It's not on the decline. The global south needs a lot of energy to keep developing, and it's pigging back to the previous discussion that was very interesting, actually. But the OECD, the most developed countries, they have the means, actually, to decarbonize faster. So what we do is we have a two-pillar strategy, oil and gas on the one hand, integrated power on the other. As far as oil and gas is concerned, we concentrate on our investments on low cost, low emissions oil and gas. The reason is, if you're going to have barrels in 2030, in 2040, in 2050, even in the harshest transition scenarios, you'll have barrels in 2050, actually, between, let's say, 25 and 50 million barrels a day, so between 1/4 and half of what we have today. These need to be lowest cost possible, because they need to be resilient in a volatile price environment, and lowest emissions possible. And we are concentrating on that. So every time we invest in a new project in oil and gas, we want to decrease the average intensity that comes with producing, the CO2 emission intensity that comes with producing oil and gas. And then, obviously, there's power. So we have been investing now consistently 1/3 of our yearly investment, that's around $5 billion per year in integrated power. We're building a renewable base, aiming for 100 gigawatts by 2030, aiming to produce around 100 terawatt hours by 2030. So to be in the top 5 players, setting aside China, which is a different space in this respect. We have integrated capacities with flexible generation, with gas and storage, and all of that brings down the huge intensity of the power generation sector. So this is how we position ourselves, and maybe I'll come to examples, but at a later part of the discussion.
Thank you. Very, very interesting. I appreciate that. And I would love to come to the examples. 100 gigawatts by 2030, you said. So maybe in the second round. So Philippe, if I may ask the same question to you, and maybe I will disclose to the audience that when we had a little hour prep chat, you said that, and we've been enjoying a wonderful partnership with Angie and with yourself for a long time. You said that I'm going to give you my firm's views, and I'm going to give you my personal views as well.
Yes, it's more general. That's my character. I'm not there for necessarily only Angie, even if I worked for 25, 26 years for Angie. But I'll take it a bit personal first. This has been a big challenge for me, energy transition, because I started my career in building thermal power plant. And that was basically a great part of my career, spending time in building a coal plant and building a combined cycle. And then I moved 10 years ago in finance, and I had to sell those assets. And I can tell you it was a very difficult, basically, change in my mind. So first, yes, there is this, but it's also people changing their mind. Changing their mind in the way they behave, etc. It's not only energy, it's the way you consume energy, it's the way you behave. And that's something for me that is really critical in the energy transition. With respect to power or energy itself, I'm producing, it can be from gas, energy is still in the gas, and believe that for the next 20 years we will still need gas. But we are moving as Total into the renewable. The challenge for me, first, I would say most of the renewable energy is intermittent. I'm living north of Paris, in fact in Belgium. We had almost no sun for the last 6 months, and only water. So you see our intermittency and this risk and a lot of wind. So it's how to manage this intermittency, and for me, what will be important is to have the mix in technologies. Second, but really Europe needs to invest basically in more in transmission, because we had sunny region in Spain. I think that it was 30 degrees in February in some days, very sunny, and it was freezing in north of Europe. It's really interconnection. This will really require a lot of investments, and this means also solidarity between the people, the countries. So basically the south, the north, and in the north of Europe, there are projects to interconnect the offshore, where the wind speed is not at the same time. So it's really a clear focus on interconnection. Second is also the market design, I would say. You know all, you are paying your electricity bill for those living in Europe. The power price were at 150, at least in the wholesale market, a year or 18 months ago. Today they are probably at 40, 50 euro per megawatt hour, so divided by 3, a lot of volatility in the power price. So it's also the mechanism that people put in place, or the government put in place, to support stability. Because when you have volatility, your cost of capital increase. Definitely. So that's really a key element. We are starting to see, and you have some industrials. I think I was seeing somebody from L'Oréal. We signed with them a corporate PPA for green energy in Brazil some time ago. But it's also having long-term contract, which brings stability to investor and also bankers. Because when I discussed with bankers 5 years ago, I was asking them, can you take merchant risk or uncontracted risk? They couldn't, but okay, they had started to make the efforts. So on this is also stability of the power price. So big also a change and importance of the regulation.
Thank you. Appreciate that. I'm going to refer your banker question to Henrik Reber. I'm a moderator today. So we'll come to that in a second. Right? We said that during the opening speech, we're not going to talk about the French elections, but there was another heading in the FT today, which talks about the tariffs that Europe is considering in terms of the importation of electric vehicles. So there's a lot of discussions around, driving the energy, and politics come into play. But one thing I would probably say is that has been a real success in this transition is when it comes to, wind and solar energy. It used to be discussed as a new technology. I think it is now a conventional because success story is there. And Vestas has been at the forefront of it, is at the forefront of it. But please share, Andreas, your views when it comes to energy transition. Also, the big development that we've seen with Vestas and in the offshore wind production capacity. Thank you.
Yeah, thank you for that. So I'm actually going to start with a little bit of a history lesson from that side, right? Because Vestas is a company, we've been doing wind for 4 decades, or even more from that side. And we're actually at a somewhat critical point within the last couple of years, given this transition, etc. Because when we first kind of started in this industry on the back of the oil crisis back in the late 70s and 80s, that kind of opened up the need for actually having what was then called alternative energy. Not renewable energy, just alternative energy on that side. And as some of you will know, people don't really use that word anymore. Now, what happened for the first many, many years of our history was that the big questions we got out, both when we spoke to bankers, when we spoke to equity investors and everyone else, is when are you going to reach grid parity in terms of the cost, right? Because in the beginning, both winds and others, alternatives that's in, like, they wanted grid parity. And it was basically just one big race to try and see when can you reach grid parity. Now, that journey took a while, but we're now there, particularly on onshore. We're way below grid parity. Offshore still has a little bit to lag to onshore, but kind of been through that journey, right? Now, going through that journey, we now actually made both wind, solar, and some of these other sources of energy an actual alternative to supplement. It's not about wind versus solar or wind versus something else, right? These things all supplement each other because, as we said in the beginning, we need to balancing out. And at some points, the sun isn't shining. Sometimes the wind isn't blowing. And the unique thing about the power market is they always need to balance. So we need to make sure that the investments are actually broad enough to ensure that we have this from that side. Now, we've kind of solved the issue around the cost side. Now the big question is around scale, right? Because we've all seen the big numbers in terms of how much energy we need, both for the decarbonization of it, for the energy independence that is also being discussed, etc. So now it's a question of scale, not just in terms of gigawatts generated around Europe, but also around, well, all the interconnection and the grid on that side. So the entire setup needs a lot of funding, and that funding needs to come from somewhere. As we've seen, the entire sector grows, the funding needs has also grown, and with the projections we have out to 2030 and 2050, those needs for capital is just going to explode. And where does that capital come from, right? Because we've seen the equity markets provide capital, we've seen the banks provide a lot of capital, we've seen the debt capital markets provide capital. Now the governments and the EU are also starting to do things. EIB announced their big wind package last year for 5 billion euros to support kind of the growth of the wind industry. We are seeing different movements there. The question is then intent versus action, what we could maybe see a little bit, but we are seeing the need come there, right? And one of the things we focused on a lot as a company is, all right, we need to prepare for that growth and we need to prepare for that acceleration to actually have the right capacity to do that. And that's going to require capital in one form or another. The banks can't necessarily provide that. Our shareholders are very expensive if they have to provide that, etc. We need to find somewhere else. And we investors have been on that journey is how do we make sure that we have enough capital to fund that growth, right? Because we need that. But it's not only us. Everyone else is competing for that exact same capital because our competitors will also need to ramp up their capacity. The other sources of renewable energy also needs that capital to kind of ramp up. And at the same time, we need all these other investments in infrastructure and cabling to make sure that everything actually flows and become efficient in it, right? So we cannot just put everything in one place. We actually need a diverse focus on that. So everyone is around fighting for the same capital, which means capital needs to go up. So we need to make sure that that funding platform is diverse to avoid too much concentration, right? Because if we concentrate the capital too much in particular pockets, we're going to hit ceilings, we're going to hit bumps, we're going to hit change in regulations, we're going to hit change in sentiment at some point because this is a long way journey, right? You said, well, 2030 is 6 years out. Well, 6 years is still actually quite a long while because we have a lot of stuff to get done. 2050 is even further out. We need to make sure that we actually have a robust way of funding this and we have a diverse way of funding because this does require a lot of capital and that cannot just come from one pocket. That needs to be spread out and the burden of that needs to be shared with everyone.
Thank you. Thank you very much. Actually, it's a nice segue to, you know, I guess the question that I wanted to ask Henrik. So when we look at the capital needed, as Andreas rightly alluded to, the numbers actually vary quite a bit, right? So we are talking about $100 trillion to $300 trillion by 2050, right? So that's the magnitude of the investment needed, right? And a lot of that search for capital is in developed markets today. But developing markets just around the corner, actually that's where most of the investment is needed. But the investor focus has been on developed markets, right? So I would like to ask you, I think, two related questions. One is obviously kindly share us Standard Chartered's views on this and what you've been up to. And also from a banking market perspective, because banking market has been at the core of financing these capital investments. Do you expect that to continue, or do you expect, as Andrea has alluded to, that I think sources to go beyond the bank market when we look to 2030 and 2050?
Thank you. We've touched upon many interesting topics already, and we're delighted to be here with some of our core clients. And also interesting also to be in Paris, because 50% of renewable financing in the loan markets, for example, has come out of the EU this year. And to your point around developed markets, we expect that to actually continue, with Europe being a leader, and particularly around France being a leader in this space. As a bank, we're very committed to the sustainable agenda. Our target is to do about 300 billion, but as you say, there are many, many different numbers out there. What the actual accurate number is, I think it's difficult to define right now. We've seen in solar that's been very successful and how that's brought costs down. We've seen in wind also, to your point about the actual cost of these projects is coming down. Through COVID, there were some supply challenges to get the project working, but I think that's coming back online. So I think the scale is a really interesting point. And scale and attracting capital is also linked to return. And I think what's been seen the last 12 months is also with higher yields, a lot of new capital has actually gone into the infrastructure space, which is driving that forward. One of those areas has been private credit, who's now a lot more prevalent in their traditional infrastructure financing than has been the case before. Historically, a bank market, to also as raised earlier, banks' willingness to take construction risk, contract risk, all these challenges. There are new entrants coming in who are willing to put significant capital to work at a good return and also help drive this forward. I think the private credit space will be very interesting. They're also backed by a lot of the large sovereign wealth funds, the pension funds, etc. That may lead to a little bit of disintermediation for the banks, unfortunately, but it may help overall grow the total scale of the market. So from our perspective, we're very positive around the sector. We think it's going to continue. And new forms of capital will also, I think, be very important for new technologies. Banks do not tend to be very good at new technologies. They tend to take risk management, take a little position, and we'll see how it goes. So I think bringing new capital there is critical, but it's going to be driven very much by the development markets, driven by the EU, driven by the US. Even with the challenges around policies in the US, the renewables has gone a considerable way, even in areas like Texas. So I think we're very upbeat about the future and working together. The one point that was touched earlier by our lead speaker, which I think is incredibly important, is about regulation and rules. So Basel, for banks, unfortunately, is quite punitive around renewables. So that doesn't seem like potentially the best way to be going. And also is touched upon securitization. Securitization, CLOs, other ways of repackaging this type of risk are incredibly important to deliver more capital into these markets. So we would be a big advocate of the EU or other regulators trying to move the markets forward and develop it with the private sector.
Thank you. I was going to ask you about the examples, practical examples, which I will still, but if you allow me to continue from what Henrik mentioned, right? So you are the president of strategy and sustainability. If I'm not mistaken, your previous role was that you were heading the M&A business at TotalEnergies, right? So in terms of the bankability and access to capital, right? The points that I think Andreas and Henrik both mentioned, I, of course, feel that it's probably the most important enabler along with regulation, because without governments you can't do that, right? What has been your experience when you look at the your dealings in terms of the bankability and the bank availability of some of those critical projects when we talk of energy transition, please?
And it's a very good point. And actually, I must say that, again, making this conversation to the previous one, interest rates is a big issue because low interest rates were a driving factor underneath the pace of the energy transition. So today, new interest rates environment is a huge challenge, frankly. As far as we're concerned, we have the luxury of having the oil and gas cash flows, actually. So I must say, and as I was heading M&A, we do most of our new energies, let's say, developments internally, that's organic development, because we do have our cash flows to finance that. And now going to the concrete examples, even though we have our cash flows and we can use $4 or $5 billion a year around mostly low carbon electricity, low carbon molecules as well, and I'll touch upon that afterwards. No, our shareholders, obviously, they expect a return, so they won't let us do anything with the cash flows. Otherwise, they'll ask us to return the cash flows, basically. And they will have a point. So we need to be careful there. And what we do is when you look at the electricity markets, we are going for very clearly targeted electricity markets where they are unregulated or deregulated, rather, markets. So Western Europe, obviously, is a great choice. The US, Texas, is a fantastic choice in this respect, and I fully agree. And Texas is a multi-energy state today, and I'll give examples around that, even though it's not in Europe. So we're targeted, and Australia is part of that, Brazil is part of that. So we're going for certain jurisdictions because actually you want jurisdictions where there is price volatility, because this is where we can create value by integrating into the electricity value chain. So what we do, like in the UK, like in Germany, is we invest in offshore wind, onshore wind, solar. So in the UK, we have now an offshore wind facility in operations that has 1.5 gigawatts installed capacity. We have projects in Germany of 3 gigawatts. There's an auction round for new capacity that's around the corner this summer. We have a lot of onshore capacity actually in France. We've reached the 2 gigawatts capacity in France. We have a lot in Spain, a lot of sun and wind actually too in Spain and Portugal. So that's the perfect place. There's wind in Belgium, in northern France too actually. So we have all of that. We have all of this capacity. But then what we also have is we need to integrate into flexible assets to deal with intermittency. And what we have is storage. And actually this has been the most recent development. Now you're starting to see, let's say, at scale storage capacities that can manage intraday our market needs, not season-wide market needs, obviously. That's still the constraint around electricity. So storage is now a tool that we use to deal with intermittency, flexibility, and capture the value where you can, meaning around the price volatility on the wholesale market. And obviously, you have the gas-fired power plants, because if you want flexibility, you need to have something that's very flexible. You can start up rapidly, turn down rapidly, and there are really two ways to do that. That's coal or gas-fired power plants. One day, hydrogen-fired power plants might play a part, still very expensive. Actually, there are technical bottlenecks and economical bottlenecks to overcome, but these will play a part 2030 or maybe 2040 plus, actually. So this is what we do concretely in Spain, Germany. So we integrate along the value chain. We can capture value and deliver a yield that's sufficient for our shareholders to say, okay, you can invest a significant chunk of your cash flow into electricity. And one word around regulations, they play a very significant part, sometimes a positive part. We need signals to invest. We need significant long-term signals that will bring comfort for our investment decisions. We can't have swings. Elections in this respect, around democracy, they can be dangerous because we don't want swings around regulations. We want to have predictability in the course of 20 years because we're talking 20 years time span here. And when you look at the EU, they've done some cumbersome stuff. They've done some very interesting stuff around sustainable aviation fuel. There is a clear regulatory mandate to incorporate more and more sustainable aviation fuel, biofuel, e-fuel, starting in 2030. And that's going to stay. When you look at the EU Parliament, the EU Commission, the EU Council, regardless of the elections, actually, that's going to stay. So we know there is a clear case for investing because there's going to be demand. So we can invest on the supply side. So we've converted one refinery in France into a biorefinery. We're converting another one that we will start production next year to produce 250,000 tons per year of sustainable aviation fuel in the south of Paris, in Seine-et-Marne. We have co-invested in a JV with Sinopec in China. And so we're doing a lot more of that because we know there's going to be demand. So signals, as far as we're concerned, are very important, both on the demand and the supply side. And one last word around that. Around clean hydrogen, what we've done actually, because we want to break the chicken and egg syndrome around is there going to be hydrogen demand, is there going to be hydrogen supply, we've actually launched a call for tenders for our European refineries so that by 2030 we procure 500,000 tons of clean hydrogen from the market. And we've just concluded our first contract with Air Products, and they're going to deliver 70,000 tons of clean hydrogen in 2030 for our European refineries. So we are on the demand side of hydrogen for our refining purposes. Actually, we'll be on the supply side because we are building the bricks around that. And we want to play this interesting part of both supply and demand. Infrastructures play a big part in the middle, so that we do transition away from fossil fuels in energy systems, because it's not about supply, it's not about demand, it's about supply and demand, and what's connecting the two, meaning logistics and infrastructure, actually.
Philippe, I'll ask the same question to you in two ways, if I may. One is, I guess, perhaps some concrete examples of the working technologies, bankable projects. But I know that, because I talked about this before, as Aurélien mentioned, the role of the regulators. I agree that I think, it's positive. I think it's hugely critical, but not always, it's positive, right? We are trying sometimes. So kindly share your views with us on that as well.
Yeah, first I'd like to come on some point to illustrate how capital costs will be really critical for the energy transition. If you look in the past, if I put aside the exploration production, producing a megawatt hour on electrons with a combined cycle, compare with the same quality of service, with batteries, with PV, with wind, is between 4 and 5, sometimes 6 times more capital intensive, the same electrons. So you can imagine, except the oil and gas, I would say, part, but it's 4 to 6 times more. So you see the capital that needs to be mobilized. It's much more investments than in the past. That's clear. That's really important to remind. To answer your questions, in terms of technologies, I think that I have really, in terms of, I would put it more on the regulation first. The big problem also in Europe, I would say, onshore, is the permitting. It's much, much too long to get the permits to get the project accepted. That's, in Europe, the biggest challenge for me on the medium term that the governments needs to solve. If I take France or even my country, Belgium, from the date you have identified the site to the start of the operation of your wind turbines, it's between 5 to 10 years. It's not possible. That's, for me, in terms of regulation, this is the biggest challenge. I would say in terms of technology, and then maybe it will be a good transition to my colleague from Vestas, is I really believe in floating offshore. Today, most of the offshore has been on bottom fixed, so it's low shallow waters. It's really the floating, and there is a huge potential across Europe on floating, but there we will need to reduce the cost. We'll need to get our lenders comfortable to take more technological risk. This will take probably a couple of years for the technology to mature. And I think there will be some issues in terms of supply chain. And that has been an issue, but I suspect that we may have issues in terms of supply chain. First, I don't think we have, with European ambitions, the industry in Europe to basically deliver all our ambitions. This means that we will, and we are already relying on China, but more reliance on China. That's a risk, and Europe needs to do something. And second, I think also, and that will be my last point, I think investment or capex will continue to increase, because it's not only the power sector that is decarbonized. You are asked the steel industry to decarbonize, the concrete industry to decarbonize, and this will probably increase the cost for them. So at the end of the day, everything will go up. Yeah. In terms of cost, so in terms of need of investments.
Yeah, and that's a valid point, right? Because like we're seeing that, and even for us industry, like we're producing wind turbines that kind of generate this green power. But again, that is very steel intensive, right? We also use concrete for some of the sites, etc. We're a very ambitious company also when it comes to sustainability, and back to the Paris targets and targets for 2030 and 2050 in terms scope 1 and 2 emissions and scope 3 emissions, etc., we also are asking for our suppliers to kind of deliver on that chain, right? Because it's not just us. Because if we pollute with a lot of carbon producing an asset, well, how long time does it actually take before that asset has actually earned back that carbon we're putting into it? So the last 2 months, we've seen a lot of announcements around green steel or sustainability steel or CO2 light steel or whatever all these different companies are calling their assets, right? But again, that is a very, very energy-heavy industry. And making that transition will require huge investments again. It will require capital. Again, we also need to make sure that the demand is there and people are actually asking for these and willing to pay for these. But again, that's just going to increase the demand for green and renewable energy even further, right? Adding back to the demand. Going back to your points around floaters and fixed bottom, etc., right? Most of the stuff we're seeing now in industry is on the fixed bottom side. A lot of interesting stuff is going into the floaters, and people are still trying to figure out how to do that, right? Because back to the point around having a diverse energy source, right now with fixed point floaters, with fixed point offshore turbines, is you need the right seabed, right? And you need to right time where floaters kind of opens up your ability to deploy in different geographies and kind of balance out. But the work there is still very, very early stages, and we'll see what the different players kind of develop on that in terms of technology, because the technology pace is still there, and we still need to be more efficient, and we still need to come with new ideas. Maybe not at the pace with it previously, because some of the industries have seen quality issues because of this arms race that went on for a few years ago from that side. So we need to be smart around it, and we need to be smart around the capex that we spend on these investments, right? From that side.
Thank you. I have one more question to you, and this is something that we debate quite a bit internally at Standard Chartered Bank as well. I mentioned the offshore wind and solar as a success story as such, right? Because I think there's been lots of lessons learned, and the industry kind of really put itself into a correction way. But then it's not, again, challenge-free, right? So only a few months ago, right, some of very big companies, some of them are your partners and competitors, right? They face challenges when it comes to supply chain issues, right? Although it's a success story, still, when you talk of a deep offshore wind with monopiles, we have seen logistical problems. We have seen issues when it comes to, freight and vessels being not available, costs going up, right? So what is your view on that? I mean, do you see these as of kind of the hiccups in the system, and then it kind of they're fixed, and then we all together as one ecosystem move forward? Or do you think that some of these will need to be taken more seriously, and there are like bigger lessons learned?
So there's two different elements to it, right? So the first part is, if you just look at the wind industry, as we've been doing this for 4 decades following the oil crisis. Now, the thing there, as I said, the entire focus has been on reaching grid parity in terms of cost, right? And speak to some of our old salespeople, etc. They were in, well, the basis is we need to reduce cost of the assets every single year for 2 to 3 years, right? We had stable inflation for a long period. We had interest rates coming down and down and down, reducing the cost from that side. So we just see this, right? We're trying to reach grid parity, costs are coming down for an asset as we're becoming more efficient to it, right? And then suddenly we have this, I wouldn't call it a perfect storm, but we have different things that kind of collide, right? We have interest rates going up. We have real inflation coming in. We're seeing a lot more volatility in both on the labor side, the production side, and the input side from that side, which the industry really hadn't seen to that extent before. On the back of COVID, we have the Russia-Ukraine situation going on, but also introduced even more inflation into the commodity side. As I mentioned previously, steel is a big component of the products that we make. Russia, massive exporter of steel, sanction hit in March of 2022. That impacted the industry as well. Ukraine also had a lot of steel production that is no longer there. That impacted. So we have come from an industry that's for a long time just seen this focus on reducing costs in a relatively stable environment. And then suddenly we have this massive volatility with several things hitting one after each other. And basically because the industry is still maturing to a degree, some of those mechanisms weren't in there. And now I'm speaking for the industry as a whole, right? Indexation in contracts, hedging of commodity inputs and all these things. If you go back just a few years, whenever we submitted an offer to a customer of building a new wind park, that offer would be valid with a price fixed for maybe 12 months out in the future, 8 months out in the future, etc. But we would just sit and eat whatever there are because it was a stable environment. Now we scale that down quite materially. So you might get 6 weeks, you might get 2 months, etc. to make an investment decision. If not, we'll have to reset the price. On that side, we as an industry has also been better to making sure that that risk is spread out. So either we make agreement with our customers or our supplier to find a way to fix some of these prices for a bit while, or we're more actively in the financial markets to kind of spread it out. And that's part of this industry maturing, right? Because companies in the oil sector, well, they've seen this before, right? Because we've seen these spikes, we've seen the volatility, and that's been part of maturing that industry for a long, long time, where a lot of the renewable space is still very, very young and still learning some of these things, right? Because indexation of cost would be a natural thing.
Sure.
But if you've had your entire industry for the existence just have, all right, we're just reducing prices, stable environment, we're getting technology efficiencies, and reducing prices that way, it's not been an issue, not been a focus. We're seeing that now, right? And again, back to Philip's point, that introduces volatility to it. The interest rate points that's also mentioned, that introduces volatility, that introduces risk to it. And the risk element is also a very, very big part of this entire capital discussion, right? Because as Henrik said earlier, well, banks don't necessarily like a lot of risk. Equity investors don't necessarily like a lot of risk. The debt capital markets don't like a lot of risk. So how do we actually spread out this risk across everyone, but also across the sources of funding from that side? Because with more volatility and more risk concentrated, well, if we concentrate the capital there, so well, people are going to sit with very large risk positions that they don't want to necessarily be. So the more we can kind of spread it out, the more we can balance things out, the more better, right? Because this is very, very expensive investments. This is very, very long-term investments, right? You don't just build a new gigawatt tomorrow. No, that takes years from that side. And then if you add the permitting time or the auctioning time and all those things on top of that, well, from you start a project to it actually is done and presumably that's a very long time. And you have that just escalates that volatility even more, right?
So one very popular risk, which may add to your problem, is the technology space, and specifically data centers and production of semiconductors and so forth. And there's obviously been, particularly post-COVID, an explosion of data center building, expansion. These project sizes are now between $10 and $15 billion each, these facilities. And clearly, as when we go in for the financing, a key component is, do you have your power source agreed? And they sign up to, yes, we do. So this technology drive is also going to put on a new, I think, volatility and added drag in terms of demand for renewables. Because most of the new facilities all commit to current sustainable targets and goals, which are obviously more onerous than the past. Very bankable projects with high return. I was interested to hear your perspective. Have you seen that come in as well? Also demand from, in Ireland, big facilities. We finance them in France. They're all coming. They're needed. Everyone's using mobile phones, AI, etc. It's going to be a big drain on power.
You want to take it? No, as NG, we clearly see it. Most of the 50% of the corporate PPA we sign is with the GAFAM. It's the Googles, Amazon, Microsoft. They really want, and that's based on the data center, and that's the case in everywhere. Can be in Europe, in United States, in Australia. That's a clear focus for them. I think they are challenged on their environmental footprint, and they want to demonstrate that basically they are sourced with green energy.
Yeah, and I fully agree. And actually, this is an opportunity as far as we're concerned. So we've signed corporate PPAs with Microsoft and Amazon and the likes in the US and in Europe, actually. And just to give one example, around they need to have reliable data centers that can operate 7 days a week, 24 hours a day. But then they need to have that clean as much as they can in terms of GHG footprint. And we've just installed two backup facilities with Microsoft around some of the data centers. One is in Sweden, that's public. And it's battery storage system instead of diesel generators. So actually they have reliability with backups, but these are clean backups actually. So as far as we're concerned, it's really a matter of how do you forecast the evolution of demand. If you can forecast that, back to Texas that we mentioned earlier, if you can forecast the evolution of demand, with some reliability, with some degree of reliability, then I won't say it's an easy game because we have all of the constraints that we've just discussed and that I fully agree with. But we know we're going to be able to install some of our power generation in Texas, and actually we're doing a lot of that as far as we're concerned in terms of solar and wind, because actually data centers, they're going to be an edge. When you're in a low price environment, you're going to be selling electricity to the data centers, and when you're in a high price environment, okay, go on the wholesale market and go on the grid. Yeah. So that's going to be very interesting in terms of opportunity, but you need to have companies that like risks, and actually we do like risks in our business model. So you take on the risk, you deal with it with your integration, and I think the key driving factors as far as we're concerned in this field is, okay, let's manage volatility through integration so that we can create value and have these edges, in the value chain. And the other thing is, sometimes when you have downturns everywhere, all alongside the value chain, back 2020, COVID times, it happens. You need to have a very strong balance sheet. And I think this is actually one of our strengths. Coming from the oil and gas sector, we have a very strong balance sheet, very low gearing. So that is an enabler, as far as we're concerned, to build a credible capacity around this integrated power model.
Thank you. We have a few minutes left, and I would like to turn to the audience and maybe take one or two questions before we say goodbye. I'm going to pick one of you guys because there are some SCB bankers in them. So, so Ronan, would you like to ask a question?
But maybe to a certain extent, because ENGIE is not only energy producing, it's also servicing the buildings, as you mentioned, or even the factories. So indeed, we are working quite a lot with clients in the large buildings and in the factories to reduce their consumption and make it more efficient, I would say. But yes, for us, it's also a focus, not in all countries. And definitely, I think that you're right, that's a segment that should be targeted.
Yeah, and I would say in a way, it is not getting a lot of direct attention, less than energy, for instance. I know that for a fact. But I must say that, this is all a life cycle issue. And when you look at building residential tertiary footprint, it's about the construction phase, obviously, with steel and cement, basically, and they're huge emitters. It's about the electricity that goes into the production phase, that goes into the use phase of the building. So if you decarbonize electricity, you do something around the whole footprint, in terms of scope 3 emissions, as we say, for those of you who love the technicalities. So I think it's being indirectly addressed, but certainly, it needs to be tackled, headfront. And I think it will get there. I mean, when you look at all of the sectors I mentioned earlier, actually, the fourth one that I didn't mention was around buildings, actually, just after the ones I mentioned. So I think it's going to get there. Mobility certainly has gotten the attention. Power generation has gotten the attention of everybody in the public discussion. Methane has gotten the attention it deserves, I must say. And buildings are next, frankly. The industry, too, is around the corner in terms of steel and cement.
Thank you. Any maybe last questions? Yeah.
Well, looking at 2030, where we have very clear targets in terms of, I mentioned the 100 gigawatts of installed capacity. We'll still be producing oil and gas. I didn't mention that, but I think everybody got that. And actually around the same level of oil production as we have today. So it's rather flattish oil production, even though we still need to invest in oil production so that production remains flat, because otherwise you have a natural 4% decline of production per year in any oil reservoir or gas reservoir, actually. If you don't invest, it goes down 4% per year. So if you don't invest in oil and gas, in 25 years, production is zero, basically. So that's why we still invest in oil. We invest in gas to maintain production, to increase production for the reasons we've mentioned around intermittency, replacing coal in power generation. And then as far as power generation is, clean power generation is concerned, and flexible power generation is concerned, I've said we have around 5 billion a year, and this is getting us to our 2030 target when we do project to 2029 in our long-term business plan, actually internally, and it's getting us to exactly where we want to go. So we're comfortable we're going to get there with that level of investment. And if we are to increase investment, as some say we should, others say we should decrease the pace of investment in that field, actually. No, we can play around that depending on market's evolution, and that's back to the demand side that we're looking at very carefully so as to see where it's going. So yes, we're comfortable with our capex level.
I would answer as NG. Yes, I think that with our ambition of we are 80 gigawatt, a bit less than total at the same date. But I would put it more globally at the entire market. You're probably French. Before you had only one producer of electricity in France was EDF. I think one good thing with renewable, you have seen a lot of new people coming in. You don't need to be a big monopoly. And that's a big change for me. And also you need to be local, close to the people, because you need to access land, get the permits with the municipalities, etc. So this also has opened basically the market to many other players. And we see also sometimes as partner, some insurance company or private equity fund that want to invest in those projects. So basically, I think that also energy transition has helped to unlock source of capital that were not there in the power generation 10 years ago. And that's a big change for me.
Thank you. Yes, would you like to?
Yeah, just in terms of our, because we're not a generator, right? We're manufacturing from that side, but we do have very ambitious targets on both scope 1 and 2 and scope 3, and also material efficiency, right? And we are investing heavily on that. But just to kind of set things in perspective, so our 2030 targets for scope 1 and 2 is 0%, and then we have a 45% reduction in scope 3 by 2030. Now, the interesting bit for us is, given the setup that we have, is roughly 98–99% of our emissions is scope 3. So we only have that 1–2% within our direct controls in terms of emission, right? But as I said, we have set very ambitious targets for scope 3, which is 45% by 2030, which means we need to push our supply chain. We need to make sure they're incentivized, and we need to make sure that they're taking the right steps, right? So from that side, we spend a lot of time, we spend a lot of energy, not necessarily capex, on actually working with our suppliers to making sure they reduce their emissions, right? I mentioned the green steel previously, so I think it was last month we announced the partnership we have with ArcelorMittal on making green steel, where basically it's back to the question we had over here in the real estate is, well, how do you use those components and reduce the carbon footprint from that side? So we're basically seeing, all right, rather than doing the old coal or oil powered furnaces, well, we're doing new green energy powered furnaces, etc. We're using scrap metals instead and just redoing that back to a virgin product, and then using that, removing a lot of that carbon goes in, because it was mentioned previously, like that's where the carbon intensity is in something like steel, right? From that side. So there, because of our setup and not having the generative bit, our focus is more working with our suppliers and pushing them to that side, also moving to EVs for a service fleet, moving to, testing hydrogen-powered boats for the offshore business to try to take people back and forth, and actually going through all the way through the supply chain and just push our suppliers and help through that by setting standards.
Thank you. Henrik, any last words from you?
I think it's been a great panel. Very much enjoyed the conversation. I think it's very interesting how technology continues to evolve, both in terms of creating more efficient mechanisms to generate power, but also the demand for power. And I think the financing businesses are going to be absolutely critical in driving this forward. Now, we've touched on it already. The regulation and support from the global governments around helping to enable this, I think, will actually be critical. But it's a very, very exciting time, and Europe and France is very much a leader in this space. And we see that also a lot in our Asian markets, where all of you have tie-ups with Asian companies, Asian projects, and clearly developing markets are going to need a lot of power and a lot of renewable power, and that will change some of our global dynamics and our trade links. And lastly, we've seen some pretty exciting and maybe positive changes in the supply chains with more facilities being set up and less concentration, which is good from a risk perspective. It also creates more supply. So, for example, Mexico has seen a lot of new activity appearing in the energy space.
Absolutely. Thank you. As Philippe, you mentioned, you said, you started in NG building coal-fired and gas-fired power plants. I'm a metallurgical engineer. My first job, very short stint, is in a blast furnace in a steel-making company. I saw the bright side right away, switched to banking long time ago. But it's been a fascinating conversation. I think from oil and gas and transitioning away from oil and gas, from renewable power, from storage to new technologies, role of banking and financing, and the regulators. I think a lot more to do as Standard Chartered Bank, and as bankers, we're looking forward to working with all of you very closely, supporting you in your investments. We will be next to you, hopefully. So thank you for giving us this opportunity. Thank you for joining the panel. Thank you very much.
Thank you.